There is a strange thing I've noticed talking with retirees who have done this well and retirees who have not. The ones who executed Roth conversions during the right window rarely brag about it. They mention it casually, almost in passing, because the result feels like it was always going to happen. The ones who missed the window, who realized too late that the opportunity had closed, speak about it with a specific kind of regret. Not anger, not panic, just the quiet recognition that a door was open for a few years, they walked past it, and now the door is shut. If you are in your early 60s right now with a meaningful traditional IRA or 401k balance, you have not seriously evaluated Roth conversions. For the 2024 through 2028 window, you are walking past that door. This video is going to open it, hold it open, and show you exactly what is on the other side, so that when you walk into your tax professional's office, you are not asking them whether conversions make sense. You are telling them you have already done the thinking and you want to execute. Before we begin, this video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. Roth conversions interact with every other element of your financial picture, including Medicare premiums, Social Security taxation, state income tax, and estate planning. The execution details matter enormously, and they are the part where mistakes cost real money. The simplest definition first. A Roth conversion is when you move money from a traditional IRA or a traditional 401k into a Roth IRA. You pay federal and state income tax on the converted amount in the year of the conversion. Once the money is in the Roth, it grows tax-free. Qualified withdrawals are tax-free, and there are no required minimum distributions during your lifetime. When you die, your heirs still face the 10-year distribution rule under Secure, but the withdrawals they take are generally tax-free. The conversion transforms future taxable income into immediate taxable income at whatever tax rates you face today in exchange for permanent tax-free treatment going forward. Why 2024 through 2028 matters. The Tax Cuts and Jobs Act brackets, which are historically low by recent standards, are scheduled to sunset at the end of 2025 under current law. Starting in 2026, brackets revert to higher rates and lower thresholds. For retirees converting in the 12 or 22% brackets today, those same conversion amounts in 2026 could easily cost 15 or 25% federal instead. Add state income tax, and the rate differential is meaningful. The second factor is the age window. Most retirees have a sweet spot between retirement and age 73, which is the required minimum distribution starting age under Secure 2.0 for those born between 1951 and 1959. In that window, earned income typically drops, Social Security can be delayed, and there is room to add conversion income without crowding out higher brackets. Once RMDs start, the conversion math gets much harder because forced distributions already fill part of your bracket space. Run the baseline math. Eleanor, a retired nurse from Grand Rapids, Michigan, is 65. She has $800,000 in a traditional IRA. Her husband passed 3 years ago. Her only current income is a small pension of $30,000 and Social Security of $28,000. After the standard deduction for a single filer over 65 of $16,550, her taxable income is about $41,500. The top of the 12% bracket for 2024 single filers is $47,150. Eleanor has roughly $5,600 of bracket room before crossing into 22%. She can convert $5,600 to Roth at 12% federal rate, paying roughly $670 in tax. That is not much. The real question is whether she should push beyond the 12% bracket. Here is where the strategic thinking matters. Eleanor's projected required minimum distribution at age 73, assuming 7% growth on her IRA balance, would be roughly $65,000 per year. Combined with her pension and Social Security, her taxable income at 73 would be around $118,000. That crosses her into the 24% bracket and triggers RMAA surcharges. Her marginal tax rate on each RMD dollar would be 24% federal plus Michigan's state rate of 4.25% for an effective combined rate approaching 29%, plus the RMA impact of roughly $80 per month on Part B premiums. Now compare conversion at today's 22% bracket versus future withdrawal at 24% plus ARMA impact. Eleanor can convert an additional $35,000 above the 12% bracket limit, staying in the 22% bracket through 2025. At 22% federal plus 4.25 state, her effective rate is 26.25%. Compared to the future withdrawal at 28.25% combined plus IRMA. The differential is roughly 2 percentage points plus the RMA avoidance. On $35,000 per year over 2 years, that is $70,000 when it's converted at an effective savings of roughly $2,100 in marginal tax, plus hundreds of dollars per year in future IRMA avoidance. And the converted $70,000 grows tax-free forever. Now stretch the window. From 2024 through 2028, Eleanor has a 5-year opportunity to execute this strategy annually. Even if the TCJA brackets expire after 2025, her bracket space during the 2026 to 2028 years is still meaningful because she has not yet started RMDs. Converting annually across 5 years with careful bracket management could move $400,000 or more from traditional to Roth form. That transforms her retirement tax profile permanently. At age 73, her RMD is based only on her remaining traditional balance. If she has converted half her account, her RMD is half as large. Her Medicare premiums stay in lower tiers. Her Social Security taxation is optimized. The downstream effects compound for decades. Here's the mechanics of an actual conversion. You instruct your IRA custodian to convert a specific dollar amount or percentage from your traditional IRA to a Roth IRA. The custodian processes the transfer internally. No checks, no rollover, no 60-day rule. You receive a Form 1099-R the following January showing the converted amount, with a distribution code of 2 or 7 depending on your age, and Box 7 indicating it was a conversion. You report the conversion on Form 8606 with your tax return. You pay federal and state income tax on the full converted amount as ordinary income. Withholding is optional but generally not recommended because withholding on the conversion reduces the amount that actually makes it into the Roth. Better to pay the tax from outside funds if possible. Trap number 1, paying the conversion tax out of the conversion itself. If you convert $30,000 and ask the custodian to withhold 20%, only $24,000 actually ends up in the Roth. $6,000 goes to the IRS. For retirees under 59.5, the withheld $6,000 counts as an early distribution and may be subject to the 10% penalty. Even for those over 59.5, the math is worse, because you lose tax-free growth on the $6,000 forever. The right approach is to pay the current conversion tax with funds from your taxable brokerage account or savings. If you do not have outside funds, the conversion may still make sense, but the math needs to be run more carefully. Trap number 2, converting without modeling, Medicare and Social Security effects. A retiree who converts aggressively without checking IRMA thresholds may cross a tier and pay thousands extra in Medicare premiums 2 years later. Every conversion should be evaluated in the context of your modified adjusted gross income and the IRMA thresholds for the given year. For 2024, the thresholds for a single filer start at $103,000, $129,000, $161,000, $193,000, and $500,000. Crossing from one tier to the next can add $70 to $80 per month to Part B, scaled up at higher tiers. Trap number 3, ignoring the 5-year rule. Each Roth conversion starts its own 5-year clock for purposes of penalty-free withdrawal of converted principal by someone under age 59.5. This rarely matters for retirees over 59.5 because the general 5-year rule on Roth earnings only requires a single 5-year period. And if your Roth has been open 5 years and you are over 59.5, all distributions are qualified. But if you are under 59.5 and might need to access converted funds, the 5-year conversion clock applies. Do not convert money you need in the next 5 years. Trap number 4, pro rata rule complications for those with after-tax contributions. If you have any after-tax contributions sitting in a traditional IRA, the conversion is treated as partially return of basis and partially taxable. This is the pro rata rule, calculated on Form 8606. The formula looks at the ratio of your after-tax basis to total traditional IRA value across all your traditional IRAs, not just the one being converted. For retirees who have made non-deductible contributions over the years, this requires careful record keeping. Missing a prior Form 8606 can result in double taxation. Check every year's 1040 back to the first non-deductible contribution. Trap number 5, state tax surprises. Some states fully tax Roth conversions. Others have exemptions or different rules. Illinois, for example, does not tax most retirement income, including Roth conversions. Pennsylvania exempts certain retirement distributions. Most states tax conversions as ordinary income like federal. If you are planning to relocate, timing the conversion around your move date can produce large state tax differences. A New Jersey resident converting in December pays New Jersey income tax. The same person converting in February after establishing Florida residency pays 0 state tax. The federal bill is the same. Trap number 6, net investment income tax layer. If your modified adjusted gross income exceeds $200,000, single or $250,000, joint net investment income above those thresholds is subject to an additional 3.8% tax. Roth conversions themselves are not subject to NIIT, but the conversion income raises your MAGI, potentially pushing other investment income above the threshold. For higher income retirees with substantial brokerage account income, conversions can trigger NIIT on other income. The interaction is subtle and often missed. Trap number 7, Medicare. Part D surcharge. Most retirees focus on Part B IRMA, but forget that Part D premiums also carry income-based surcharges. For 2024, the Part D surcharges scale from $12.90 per month at the first tier up to $81 per month at the top tier. A couple crossing the highest tier pays roughly $1,900 per year combined in Part D surcharges alone. Let me walk through another scenario. Thomas and Joyce are a married couple from Tucson, Arizona, both 64. Thomas is a retired mechanical engineer. Joyce is a retired school counselor. Combined, they have $1,600,000 in traditional IRAs, $300,000 in a taxable brokerage account, and no pension. They plan to delay Social Security until Thomas's full retirement age of 67. Their only current income is roughly $24,000 in dividends and interest from the brokerage. After the standard deduction of $29,200 for married filing jointly with both over 65, their taxable income is currently negative before any conversion. The top of the 12% bracket for married filing jointly in 2024 is $94,300 of taxable income. Thomas and Joyce can convert up to $99,000 in a single year while staying within the 12% bracket, paying about $11,900 in federal tax at a blended rate of 12%. Over 2024 and 2025 combined, two conversions of $99,000 each would move $198,000 from traditional to Roth at 12% federal rate. If instead they waited until RMD age and withdrew this amount over their retirement, their marginal rate on those dollars would almost certainly be higher due to combined Social Security, pension absence, and growing account balance. Their estimated savings over 30 years, including IRMA avoidance and tax-free growth of the converted balance, exceed $50,000 in concrete dollars. Extending the strategy. From 2026 through 2028, even under sunsetted TCJA brackets, Thomas and Joyce still have conversion room. The post-sunset 15% bracket, which replaces 12%, still gives them room to convert at historically reasonable rates. Their accumulated conversions by the end of 2028 could easily exceed $400,000, dramatically reshaping their eventual RMD exposure and Medicare premium trajectory. A critical refinement. The Roth conversion is most effective when paired with asset location strategy. Place high-growth assets like small-cap stocks or aggressive equity funds in the Roth. Place stable, income-generating assets like bond funds in the traditional IRA, where tax-deferred treatment smooths out the taxable distributions. When you convert, consider pulling shares of the most appreciation-prone assets into Roth form, because that growth will compound tax-free for the longest period. This is a decades-long planning decision. Another subtle strategy. Partial conversions of 401k balances via in-service rollover, if your employer plan allows, can expand your conversion capacity. Some 401k plans permit after-tax contributions with in-plan Roth. Conversions, creating what is sometimes called a mega backdoor Roth. For retirees still working and earning, this can add tens of thousands per year of additional Roth contributions on top of regular contribution limits. Check your plan document for availability. Mid-year conversion timing matters. A January conversion gives the Roth a full year of tax-free growth before tax is owed. A December conversion lets you see your full year income picture and right-size the conversion to fill the desired bracket exactly. Consider the recharacterization question. Prior to 2018, Roth conversions could be undone within a certain window. That option was eliminated by the Tax Cuts and Jobs Act. Today, a Roth conversion is final. You cannot undo it once processed. This means you must be certain before executing. If you convert in March and the market drops 40% by December, you are stuck with the full conversion as originally calculated. This reality makes conservative sizing and multi-year spread preferable to aggressive single-year conversions. Thomas, from the earlier example, had his CPA build a year-end projection model that he reviews each November. If his income came in higher than expected through October, he converts less in the final 2 months. If lower than expected, he converts more. This dynamic adjustment, possible only because conversions happen at the custodian level without advance commitment, is one of the tactical advantages of conversion strategy over other tax planning tools. Estate planning interaction. Roth IRAs pass to heirs as tax-free distributions within the 10-year window. A traditional IRA inherited by a non-spouse beneficiary generates ordinary income tax on every distribution. If your heirs are in higher tax brackets than you are, converting now transfers the tax obligation from their higher brackets to your lower brackets, and the family keeps more of the inheritance. For retirees whose children are successful professionals in the 35 or 37% brackets, this benefit can be enormous. Consider Beatrice, a widow from Charleston, South Carolina, aged 71 with $1,200,000 in a traditional IRA, and 2 adult children both earning over $300,000 per year in high-tax states. If Beatrice dies with the full balance in traditional form, her children withdraw it over 10 years at marginal rates approaching 45% combined federal and state. They lose $540,000 to taxes. If Beatrice converts aggressively in her 70s at her own marginal rate of 22%, she pays $264,000 in tax. Her children inherit a smaller but tax-free Roth balance. The family's net wealth after tax is hundreds of thousands higher, even accounting for the opportunity cost of Beatrice paying the tax. From her own assets, the math favors conversion for this specific family. Your situation will depend on the heir's tax brackets and your own. Timing considerations for Social Security. Roth conversions. During years before you claim Social Security, allow the conversion income to flow through your brackets without also triggering Social Security taxation at 85%. Once you claim Social Security, up to 85% of your benefits become taxable when your combined income crosses thresholds and conversion income counts toward that threshold. A retiree delaying Social Security to 70 has 10 years of conversion window between retirement at 60 and claiming at 70, assuming they retired early, during which conversions avoid both the Social Security taxation layer and the RMD constraint. One final consideration. Charitable remainder trusts, qualified charitable distributions, and conversions can be layered for high net worth retirees with philanthropic intent. Converting to Roth, then donating taxable account assets to a charitable remainder trust, for example, can generate a tax deduction that offsets the conversion tax. These strategies are advanced and require coordination among an estate attorney, tax advisor, and financial planner. If you are 60 or older with a traditional IRA balance over $300,000 and you have not run a formal conversion analysis, set a meeting with your tax professional this month. Bring your most recent account statements, your Social Security benefit estimate, any pension information, and a rough budget of your annual expenses. Ask them to build a multi-year conversion projection through 2028 that models bracket filling, IRMA impact, and expected RMD timing. That one meeting, done well, is the foundation for decades of optimized retirement tax planning. Before you close this video, I want you to do one specific thing. Go look up your traditional IRA balance, add any 401k balances at former employers, and write that total number on a piece of paper. That is the amount of taxable income waiting for you in the future. Every dollar of it will eventually come out as ordinary income at whatever tax rates exist at that time. Roth conversions are your only tool for changing when and at what rate those dollars are taxed. If this helped you understand how conversions fit into your planning, please subscribe. Because the next video in this series walks through the exact step-by-step meeting script to use with your CPA when you ask them to build your conversion model. And leave a comment telling me your conversion story, whether you have already done some, whether you are planning to start this year, or whether you had never heard of the strategy before today, because understanding what retirees actually know and do not know helps me make the next videos more useful.